Today we're going to fix the most common recurring problem that retirees have with their finances. Specifically, retirees have a tendency to freak out when the market goes into a decline and they see their stocks lose value. We will show you how to protect yourself against that problem. And make sure to watch to the end, where Larry shares a tip I've actually never heard anyone else ever talk about. If you invest in the stock market like we do, you can't completely avoid market downturns. They happen. But you don't need to freak out when the market gets rough if your finances are organized correctly. When you set yourself up right, you can protect yourself from market declines. And we're going to show you how to do that. But first, Larry has a couple of things to tell you about the stock market.
Thanks, Neil. There are two things most people do not understand about the stock market. The first is that declines are historically temporary, not permanent. So even though I understand why people have an emotional reaction, you really don't need to get all upset when the stock market declines by 20 or even 30%. It's not like the stock market will go to zero. And I don't know if this is going to make you feel better or worse, but let me tell you something. If it did go to zero, we'd have a lot bigger problems to worry about than your investment account balance, like total chaos and anarchy. But I digress. Market swings, painful as they are, sometimes are normal. Historically, the market has temporary declines, then temporary advances, followed by temporary declines, and on and on. Take a look at this chart. This shows that since 1940, the market has done really well despite wars, assassinations, recessions, stock market crashes, financial crises, global pandemics, terror attacks, etc. You know why? Because business is really good at adapting to new situations and finding ways to make a profit. So, history suggests that to bet against the market for the long run would be risky and foolish. The second thing that people don't understand about the stock market is that it rewards longevity, meaning risks go down over time. So this is a historical look at what actually happens in the stock market and your chance of losing money. Now, over any 1 year period, you have a 30% chance of losing money. But if you sit tight for 5 years, over any 5 year period, the chance of you losing money drops to 11%. If you maintain your position in the market over 10 years, your chance of losing money is only 3%. And based on almost 100 years of history, if you hold your position in the market over 15 years, there's been no 15-year period where you would have lost money.
We're not saying that you need to hold stocks for 15 years. What we're saying is that you're far better off if you don't depend on your stock portfolio for withdrawals over short periods of time.
What are you talking about?
That way, you can allow your equity to grow. And the longer you do that, the lower the risk, as you saw a minute ago. What I'm saying is that you should have adequate cash reserves so you don't have to pull money out of the stock market in the short term. Why? Because you can't assume that in the next 12 months, it'll be okay to pull your money out of the market, because the market has a significant chance of declining over the next 12 months. And if you depend on your portfolio for short-term needs, you could be forced to sell at low prices. If you're able to delay pulling money out of the stock market when it's down, if you're able to hold your stocks for longer periods without touching them, your retirement finances will historically have been much better off. And you'll feel a lot more relaxed. And speaking of feeling a lot more relaxed, a great way to do that when it comes to money is to educate yourself. And the best way to do that is to subscribe to our channel. So hit the bell, subscribe, and smash the like button so you'll be notified when we release updated tips for you to secure your retirement income. Enough shameless promotion. Anyway, one tool that I used over my entire professional career and my personal life was the bucket strategy, as Larry explains here.
So you divide your money into buckets so that you never need to pull money out of your stock investments in the short run when they may be down during a market decline. You have one bucket for the money that you'll need in the next 24 months. This would be money market funds, CDs, other cash, things that are readily available. Then you'd have another bucket for money you would need in the next 2 to 5 years. That might be short-term bonds. Then you'll have another bucket with money that you would need in the next 5 to 10 years. Those could be longer-term bonds or high dividend stocks, which tend to decline not very much during bear markets. And then you would have a bucket of money that you would need for 10 plus years into the future. These could be your growth stocks or stocks that you don't need to rely on in the short term, so that if they decline, you have plenty of time to let them recover without needing to take money out of that bucket.
Now, if you use this strategy and we encounter a bad market and your stocks decline for 2 or 3 years, it won't matter. It won't matter to you because you don't need to touch your stocks for several years, and the stocks should have time to recover if they suffer a steep temporary decline. You might ask, well, what happens if I need to tap my portfolio for income before the market's recovered? Also, in that case, I think you can relax. You might need some money during that time, but you don't need all your money. And you won't take any losses on money that you allow to stay in and recover, only on the money that you withdraw. Let me give you an example. Let's say you have a $1 million account, and let's say that you've exhausted your cash and need to tap your account to the tune of about $50,000 a year. Let's say that the market takes a dive and doesn't recover for 2 years. So in this example, you'll need to sell off $500,000 of your equity in the first year and another $50,000 in the second year, for a total of $100,000. So if the market is down during that time by, let's say, 20%, and you've sold off that $100,000 at a 20% loss, you will have lost about $20,000 because you sold off that equity when the market was low. But remember, you have another $900,000 still working for you in this hypothetical example. So you didn't lose anything on that money. The point is, keep it in mind. Remember that even when the market is rough, the losses will only be on the money that you've actually withdrawn. And hopefully that adds a lot of peace of mind and allows you to relax.
Good point, Neil. So that begs the question, when do you move money out of your stock market bucket into your more conservative buckets? You set an objective such as 7% annual growth for your stocks. Over 10 years, that would mean that your stocks could double in value. However, if they double in value before 10 years, you take half of that stock portfolio and move it to one of your more conservative buckets to protect it. This simple system makes you liquidate stocks when you have a profit rather than forcing you to liquidate stocks in a bear market. Another way to do this is as follows. Every year your stock bucket increases by more than 7%, you move the excess into your other buckets. That way, you harvest your stocks in good years and reduce the probability that you need to touch your stocks in bad years.
Genius!
People seem to forget that the stock market has a fairly predictable pattern. The stock market historically goes up, and then it goes down. And then it goes up to a new high, and then it goes down. And then it goes to a new high, and then it goes down again. So we can clearly see that in most cases, the people who suffer from stock market declines are the ones who sell in the decline. People who had their money separated into buckets and could leave those stocks to recover usually do just fine. I want to be sure that you understand that the bucket strategy isn't a guarantee. It simply reduces the chance of permanent losses and gives you peace of mind during the market downturns. You can comfortably hold your stocks during downturns because you know you don't need to sell. In my personal and professional experience, having this peace of mind and having plenty of cash on the side is the key.
All excellent points, my Crusader bro. Let's also explain a related issue that will give you clarity about your investments. When you hear other people talk about recession, that should have little meaning to you as a retiree. Why? Because recessions do not always mean market declines. The stock market has a different cycle than the economy. Take a look again at this chart. Notice the gray shaded vertical bars. These are recessions. Also notice that we have had recessions while the stock market was declining, and we have had recessions while the stock market was increasing. So next time you're at a cocktail party, and assuming you're sober, and some know-it-all talks about recessions as bad for your investments, you can correct them because you now know that recessions in the stock market performance are not the same thing.
Let's share one more tip to make sure you avoid touching your stocks in a down market. Rather than sell stock if you don't need cash, you can borrow against them. This isn't for everyone, but it's a very clever idea to think about, to consider. Let's say you have $100,000 of stock and you need $30,000. You can borrow that $30,000 without selling shares if you want to. Larry has accounts at Interactive Brokers because the borrowing rate, called the margin rate, is under 3%. And that's less than half of what other brokerage firms charge. Now, that's really attractive when mortgage rates are now at 6%. In the description below, we've provided a link for you. You can use that link to open an account at Interactive Brokers. And should you ever need cash fast and want to take the option of borrowing, you can borrow against your shares with that account. And the link below also entitles you to a nice reward up to $1,000 worth of Interactive Broker stock when you open a new account. Pretty good. But again, keep in mind that nobody knows how long a market downturn is going to last once it starts. So if you borrow money and the decline lasts longer than expected, you could be stuck making those interest payments for longer than you thought. So this is a smart alternative, but it's not for everyone. Of course, you can't borrow from an IRA account, so keep that in mind. But anyway, both Larry and I love Interactive Brokers, and even if you don't need to borrow against your holdings or don't want to, they are a really good brokerage firm. They're very easy to use and they're inexpensive as well. So consider checking them out. To view plenty more ideas on improving your retirement finances, your liquidity, and your spendable income, click subscribe below and then the bell icon that appears so you get notified when we post a new video. Until then, we will be crusading for more great ideas to help you win the retirement income battle.